Hello and welcome to today's webinar, Rethink, Transfer Pricing Perspectives from Around the World, Navigating Through Crisis and Complexities Spotlight EMEA. Before our presenters get started, I'd like to take a moment to go over some CPE and support information with you. To receive CPE credit for today's webinar, you will need to actively participate throughout the entire program by answering at least 75% of the checkpoints that you will see on your screen. Your pop-up blocker does need to be turned off to enable the checkpoint pop-ups to appear. If you have any questions regarding the material being presented, please use the Q&A icon at the bottom of your screen. The presenters will review and answer questions as time permits. Information on group participation is available by clicking the handouts icon. Should you have audio or technical issues, BDO employees can contact technical support at 888-236-9111. Alliance, international, and invited guests may contact support by calling 844-580-6963. And now at this time, I would like to turn the presentation over to Paul Daly. Go ahead, Paul.
That's great. Thank you very much. Hello, everyone. My name is Paul Daly, and I lead the transfer pricing practice here in the UK. I'm joined today by an esteemed panel of BDO transfer pricing leaders. So we have Oren Novis from BDO Ireland, Sabine Sardou from BDO France, Marcus Stella from BDO South Africa, Frederick Finks, BDO Netherlands, and Richard Wellman, BDO Germany. We'll be hearing more from our panel very shortly. So these are uncertain times, but I think one thing everyone can agree on is that we are living through a time of great change. We're of course in the grip of a global pandemic. COVID-19 is rewriting the rules of how we live our lives and how our business is conducted. It's accelerating new ways of working and putting more emphasis on a digitalized economy. It's an enormous, exceptional event that the world is trying to process. In addition to the impacts of COVID, we have significant political changes. Across the Atlantic, the US elections are in the balance. Closer to home, we are seeing a very different relationship between the UK and the EU being hammered out. Macro political and economic forces are causing businesses to rethink their location, their business models, and how it is that they operate. We're also needing to think about transfer pricing and international tax in a different way. These are subject to change. The OECD have produced detailed blueprints for Pillar 1 and Pillar 2 of a unified approach that was born out of a response to the tax challenges of the digitalized economy, and now with potentially far-reaching consequences for all businesses. There are of course many other changes at regional and national level, each with their own importance, but today we're going to cover three main topics. So the first, the potential solutions to transfer pricing issues resulting from COVID-19. Secondly, the impact of increased global supply chain restructuring for transfer pricing. And third, the transfer pricing implications of the OECD blueprints on the tax challenges arising from digitalisation, i.e. the blueprints for Pillars 1 and Pillars 2. So on our panel today, we will discuss these issues, and we will also be asking for your views in polling questions, and please do raise any questions as we go through in the Q&A box, which we will take if time permits. Otherwise, we will follow up with you after the session. So I'd like to take us to our first topic and hear our panel's views on some of the practical solutions to transfer pricing issues resulting from COVID-19. Now, we know there are fundamental impacts to businesses, and groups will need to make decisions leading to potential uncertainty for business as to how those decisions will be received, and the potential for disputes between tax authorities when the consequences of these decisions come up for audits. The OECD are looking at the potential for issuing additional guidance on a number of these core topics. And whilst yet we have not seen this, we know it is an important priority topic for them. So I'm going to turn to my panel and ask, please, Frederick first for his views on some of the headline issues and what it is that we could potentially do to think and mitigate those. Frederick.
Thank you, Paul. I'm Frederik Vinks from BDO the Netherlands, and I would like to talk to you briefly about the interaction between government support and the COVID-19 crisis that we are in. In the Netherlands, we are an open economy, and we have severe impact from the measures that we're taking due to the COVID crisis. We have a huge decline in our gross domestic product for both Q2 as well as now for Q3, although the numbers seem to be a little bit better. Our government has taken some measures to support business, and the measures they range from job retention schemes, direct grants, but also guarantees or even loans, so-called Corona bridging loans for small startups and scale-ups. And the impact shows of these measures. If you look at the unemployment numbers in the Netherlands, they are only up slightly from where they were before the crisis. But what to do with this support? There's a number of countries, and the OECD has a nice overview of that across the globe that provide similar types of support. Most of them are job retention schemes. What to do with these? Where there are sorry about that. Where there are several authorities that have indicated that they would like to prevent that the support that they have given to the taxpayers is exported abroad. Especially, this becomes clear when you talk when you apply your TNMM with a cost-plus basis. What is the impact? How is the support accounted for? Will it reduce your cost base, or will it be taken into account separately? And the OECD, unfortunately, up to now, doesn't give us a lot of guidance. The only place where they talk about subsidies and government support is in the effect of government policies, where they basically take support as a condition in the market of a specific country, and that you should look at how the prices between the intercompanies are whether they are consistent with what independent companies should do. So that doesn't provide a lot of help. In the Netherlands, there's a little bit more specific guidance, especially when you look at the cost plus application and whether or not to include the support in your cost basis. In the TP decree, in the TP decree, it says that where there's a direct relation between the product and the service and the support, you can take it out of the cost base. If that isn't the case, then you should not include it in the cost base, which basically means that you have to report it separately in your P&L. So, as Paul mentioned, we are awaiting the outcome of the OECD guidance, and we hope that they will also address some language on how to deal with this matter. But until then, you should look at it on a case-by-case basis. Look at what the nature of the subsidy is. Look at the impact it has on the pricing, and look at the local rules and restrictions that are out there. So, to be short, look at the support that you get and build a case and build a story to defend that in your local documentation.
Great, thanks, Frederick. And yes, absolutely. I think there's a case of being very clear and careful as to how the local scheme is implemented. So, for instance, it might not remove costs, it might give you instead a different additional income, and this will be an important distinction when we come to calculate and transact service-based charges as just one example. So thank you for that. Next, perhaps I could turn to Marcus. Marcus, could you give us a view on a headline issue, please, and some of your thoughts around that?
Yes, thank you, Paul. So just quickly, I'm Marcus, and I'll be looking at South Africa. So to just give a quick background on South Africa, from an economic perspective, we've been also hit very hard, and I think that's probably the general story during the COVID pandemic. But just there isn't just the normal economic hits that we had in South Africa. We also were hit very bigly with our tourism industry. And for those of you who don't know, we very much have a big share of our GDP that comes from tourism. And a lot of that does come from countries like the UK, Germany, and the US. So that went down to zero during the lockdowns. And now, obviously, with the new lockdowns that are on the horizon, this might come back to again to zero, which is going to hit us very hard. In South Africa, we've lost approximately 2.2 million jobs during COVID. And even though some of that has recovered, we're really not back where we used to be. And in South Africa, we probably only have about 25 million people who can work. So losing 2.2 million of those is close to 10%, which shows you how big that number is. That did result in company taxes contract.
Okay, so we seem to have lost Marcus for a moment there. Marcus, are you back with us? Can you hear me?
Yes. Sorry, can I? Okay, great. Then maybe not to repeat that, but to look at the taxes rather. So South Africa did also offer tax reliefs, and those came mainly in employment tax incentives as well as tax deferrals and payment holidays. But sadly, unlike the UK or the European countries, we don't have a big war chest, which means that we couldn't offer many reliefs, and most of the money that we used to give some relief was done through borrowings, which is obviously going to be a future problem. Talking a bit more around transfer pricing, we've got the associate enterprise definition coming into South Africa. So that will soon widen the net of companies in South Africa that need to look into transfer pricing. And we're also looking at introducing in 2021 an interest expense limitation rule that is saying that only 30% of the net interest expense to EBITDA is going to be accepted. Interestingly, also our commissioner from SARS has just spoken this week, and he's also mentioned things that he's aware that companies are charging suspiciously high, as he says, interest into South Africa. So be careful around that, because we are going to see more questioning around that. And he's also said that he's aware of prices being increased during the COVID area. And again, we're expecting some scrutiny coming from that. What I wanted to also touch base on is the benchmarking and comparability during this time. And a few things have been mentioned. For example, the big one that's out there is that we are saying, but we are no meet BDO, but TP professionals are saying we should just use the full range instead of using the inter-quarter range. From my perspective, that is maybe not something we should just jump to, because there's a reason why we use statistical tools such as the inter-quarter range, and that is obviously to get a better comparability. And as you know, in transfer pricing, comparability is key, and that is really what we need. So I'm not too sure that the full range will automatically work. Having said that, if you look into things like the bond market or in the CUP study for licenses, that is maybe a different debate. But also be aware that countries, so for example, in Africa, we've got Tanzania. The arm's length range there in the law says you need to look at the 35th percentile to the 60th percentile. And other countries do also make different area, time period potentially. So sometimes the previous financial crisis is mentioned. There again, in my mind, that is not the same, and we just need to be careful. This current pandemic really shut down and locked down economies, whereas the previous financial crisis had to do more with the housing market and the banking environment. So that is very different. Sometimes the working capital adjustment argument is made, and quite rightly, a lot of guys and professionals will say, well, there isn't much of an impact here, so why look at the working capital adjustment? But do keep in mind that the working capital adjustment does look at things like accounts payable, receivable, and inventory, and that during this time is very different than the comparable data that you might find. So there is actually something that one could do in the working capital adjustment space. One can also consider the multiple year data for the tested party to smooth the impact of 1 year. So I guess the question is, over how many years does one smooth this? And again, this is maybe an argument that could be made in line with the OECD, but keep in mind in Africa, especially tax authorities may not like that. And then maybe the last point I wanted to make around comparability. I mean, the OECD does say in exceptional and extraordinary circumstances, when you have a non-recurring nature, that can generally be excluded. So I think that is something one should look at. And then especially during COVID times, one can then look at a normalized return to then consider that for the comparability study. Thanks, Paul. I'll hand back to you.
Great, thanks, Marcus. And I think you've touched there on one of the key issues really for us in transfer pricing, which is the use of data. There's always a lag built into our data. We're always using historic data to apply to later periods, but that has now become really pronounced given that we know the period we're currently in will not reflect or be reflected by some of the historic data. So the challenge really is, how do you compensate and adjust for that? Can you do that within the range? Do you have to look further back, as you say, to the last very significant financial crisis, or indeed could we look forward and use estimates and projections? There won't be any one right answer to that, and we know that that is something that we could expect and hope for, at least some guidance from the OECD on how to manage that issue. So thank you for that, Marcus. Perhaps now I could turn to Sabine and ask Sabine for a perspective on issues she's been seeing and some of the thoughts there. Okay, we seem to have lost Sabine for the moment. Sabine, can you hear me okay? Okay, we seem to have some technical issues with Sabine's connection. So perhaps I could move on to Richard and we will come back to speak with Sabine shortly. So Richard, perhaps you could share some views with us as to headline issue and some of the mitigations.
Yes, certainly. Thank you, Paul, for handing over. So by German tax authorities, there's quite little guidance, unfortunately, on COVID-19 and transfer pricing implications. On the page of the German Ministry of Finance, you can find a frequently asked questions list. I think that's last updated then in September. Yeah, but as I already said, there's hardly any guidance given on TP relevant topics. So from my point of view, the most TP relevant statements in that compilation seem to be that the COVID-19 government subsidies that are also provided in Germany are generally subject to income taxes. But that depends on the individual program conditions, actually. And also, it is stated that for advanced tax payment purposes, the subsidies are not taken to be taken into consideration. Also, according to the compilation, government subsidies are not subject to VAT in Germany, as it's no service or so being provided, but it's a subsidy. And last but not least, the Ministry of Finance states that COVID-19 travel bans or the closing of borders that lead to an interruption of construction or assembly works in Germany may suspend the period relevant for the constitution of domestic PEs. But that's not too closely related to transfer pricing, I think, and unfortunately there's no further guidance, as I already said, by the German Ministry of Finance. So I think some guidance by the OECD will much be appreciated. And one thing that comes to my mind then, maybe you've heard about the German short-term work compensation that is being provided to German or to companies in Germany, to employers. At least German media regularly stress that this is quite unique, this institution. And basically, those short-time work compensation payments, they are to be computed and made by the employees. So, for example, if employees cannot work, I don't know, 70% of the time or some certain percentage, the employer may apply to the German Federal Employment Agency. It's not the employee himself that does so. And if this is granted, then nevertheless the employer pays the salary to the employee, and then and he is being reimbursed. So the question that comes to my mind and then is, well, is this to be taken into consideration then if the German entity, the employer, is based on a cost-plus remuneration. My answer would be probably not. As I said, there's no concrete guidance, at least not that I'm aware of, by the German Federal Ministry of Finance or German tax authorities. So from my point of view, that's quite close to pass-through costs because it's reimbursed and it's also not something that's paid for any kind of work. I mean, the employee is not being laid off. So yeah, that's my ideas on COVID-19 for the moment and transfer pricing.
Great, thank you.
So I hand back to you, Paul.
Fantastic, thank you very much, Richard. And I can hear some things in common across us already in our speaking about this, and particularly that point about guidance. And currently we don't have clear guidance from the OECD. We know that they are working on it. I rather suspect that some of the work on Pillar 1 and Pillar 2 has probably pushed back some of the timetable for the guidance on COVID-19, and I'm also aware that the OECD are aware that many businesses will start to make decisions very soon where they have calendar year ends. So some guidance would obviously be very helpful to be available contemporaneously. And I know certainly in the UK, there is a view from HMRC that they can provide guidance, but to do so in the context of knowledge of the OECD guidance. So thank you very much for that, Richard. So perhaps I can try handing back to Sabine again. Hi, Sabine. Hopefully the connection is re-established. So to invite you to say a few words on some of the issues that
Hi. Yes. As for France, we do not have at the present time specific guidance regarding transfer pricing and COVID-19. The first draft financial act has been issued recently, and we do not expect any guidance in the next future. So so the different comments which have been raised by my colleagues are absolutely applicable in the same situation, meaning that we anticipate that for documentation, there will be probably two aspects to take into account. The first, regarding the TP models, when we are talking about streamlining models with an entrepreneur and other entity which will receive a residual profit, we already have some requests from clients saying, okay, well, we want to share the situation with our subsidiaries and to guarantee an operating margin or a cost plus to such or such entity will not be possible in this context of crisis. So what do we do? Do we have to challenge the model that we put in place in the last few years or not? So we know that we will have some issues with local tax authorities by challenging the models because of course, streamlining models are specifically dedicated to this kind of situation. Limited remuneration, limited profit, but when there is a loss to be made, the loss should be taken by the entrepreneur and not by the limited risk distributor or by toll manufacturers. So we are exactly in the situation where the streamlining models which have been in place for years and years will be challenged actually. So that's the first point which will probably generate some issues in case of tax audit and for the international groups. The second point is, as Marcus said, about the benchmark and the multiple year analysis. In the next few years, we will have to include 2020, well, 2019, 2020, 2021 in the multiple year analysis, and even regarding documentation related to 2020, for instance, the years to be covered will be 17, 18, and 19. So what do we do with that? We will have to compare 3 years for which it can be considered as a normal, standard fiscal years, to 2020, which is, of course, a weird fiscal year. So in the next few weeks, in the next few months, we'll have to deal with related to 2020, and how will we handle that? Probably by making some amendments in our analysis. So will be key in our analysis, and probably local tax authorities will be also quite by the COVID. So probably the message I wanted to give is flexibility and adjustment in our legacy models and transfer pricing policy models.
Okay, fantastic. Thank you, Sabine, and thank you for working with the technology there. So we heard that very clearly. Thank you. Warren, perhaps I could then turn to you to give us some perspectives and any views as well from Ireland.
Thank you very much, Paul. I'll keep it brief to two major comments and observations, everybody. So the first one is around the political implications of government financial supports to business, and the second is around documentation and what can business people do to support their transfer pricing positions for the year ahead. So in Ireland, wage subsidies supports provided by the government was largely supported by bond raising by the government. Like Marcus said, for South Africa, the government didn't have a war chest of money to go out and provide wage subsidies to business. In the last 2 weeks, the government has publicized the companies that have taken the benefits of these wage subsidy supports to support their employees and keep them in employment. So it goes without saying that some of these supports, because it's being financed by debt raising, that there's going to be potentially a political expectation that those companies who are receiving that government money are paying their fair share of tax. So that now that in Ireland and presumably in other countries, those companies taking these wage subsidy supports are now in the public domain, there might be an expectation that their tax affairs are in good order. So that's as a perspective to have if you are a company that is benefiting from government support in any jurisdiction. And the second one, and largely to close off on this matter of what to do when it comes to irregular transfer pricing issues like COVID-19, and especially what Frederick said around government supports and the netting of government supports against your gross cost of wages. I would say in my own experience, the first place to look for what's the right thing to do is always try to apply the arm's length principle. And if you as a business, in dealing with your customers or dealing with independent suppliers, especially service companies, if you know that the prices of those services or goods are affected by government policies and government financial supports like COVID-19 supports or R&D tax credits or government grants, if you know that those government money is actually netted off in determining the fair price of a good or a service, then that is a good arm's length reference as to what should be applied for intergroup transactions. Thank you, Paul.
Great, thank you, Warren, and thank you to all of the panel for the initial views on that. I'd like to now turn to our first polling question and ask a question of all of you watching and listening today. So could we have our polling question up, please? And the question is, do you plan to, or have you already made changes to your current transfer pricing policies to reflect changes in your business resulting from COVID-19? So if you could please select one of those options, we'll give everyone a few seconds to make that choice. Okay, great, thank you. I can see those answers coming in thick and fast. So we'll go for another another couple of seconds, then we will move on to the results. So yes, if we could bring up then the results of that, please. All right, so we have an overwhelming majority for the third category, which is still determining if changes to transfer pricing policy and or pricing is needed. And I don't think that comes as an enormous surprise. We are in an incredibly fluid situation, both economically, with regard to the transactions themselves, but also the guidance and the context of the principles that we are looking to apply here. So clearly, some more thinking to be done. And that leads me into our next topic of conversation. So far, we've really been talking about some of the immediate impacts of COVID-19 and the impact on policy. I'd like to change the focus a little bit now to, well, what is this meaning for businesses? So, in light of all of the impacts that we are seeing of COVID-19 and the macro political and economic forces, we know that businesses are rethinking their models. So we know that there are changes to supply chains, changes to organization, there are changes to markets that businesses will service, there's changes to product flows, to services. So in this part of the discussion, I'd like to look at some of the consequence of rethinking of business, of restructuring of supply chains, and what that means for transfer pricing. So perhaps I could ask Warren to start us off on that with some views on what it is that he's seeing businesses do, the consequences are for transfer pricing.
Thanks again, Paul, for coming back to me. Maybe reflecting on Ireland's economy, like Frederick said for Netherlands, Ireland's a relatively small economy, small population globally, and highly exportive. A significant part of the Irish manufacturing base is in the life sciences and medical devices and pharmaceuticals. As everybody probably expects, both of those were heavily influenced by the COVID-19 health pandemic. And a lot of businesses operating here with footprints internationally have had to rationalize their manufacturing and procurement around medical devices and treatments for COVID-19. There's a significant amount of high levels of expertise in manufacturing ventilators and respirators here in the country, and to respond to global demand for those types of devices to save lives. A lot of businesses here have had to get rid of or reduce the amount of manufacturing of non-critical devices or non-critical medicines that don't serve COVID-19 issues. And so there's been a significant shift of what is being produced here that is of urgent need, and there's been a shift of any supplies. Let's say if to make a certain type of medical device, you have to purchase certain types of raw materials. Now you're redirecting those raw materials to different manufacturing sites around the world because you're now concentrating certain manufacturing in one country. And that's caused a significant amount of disruption, but not just for the tax and finance functions within businesses like this, but significantly for the procurement, supply chain, and logistics teams. And so whether those procurement functions are done as a centralized organization or domestic in country, that will have a significant knock-on effect to transfer pricing arrangements. Who is buying what? Are they buying it? Are they buying those raw materials intercompany and then managing inventory intergroup, or is it directly purchased by the manufacturing location? I think there's significant disruption to intergroup transactions arising from the shifting manufacturing footprints of business. That is a challenge for businesses that are both struggling during these times, but also for those who are actually doing very well during these times.
Okay, fantastic. Thank you. Well, perhaps now I could turn to Richard. And Richard, maybe you could give us some thoughts on some of the tax and transfer pricing consequences of business change. Okay, we seem to have lost Richard for the moment. All right, so I'm afraid that Richard, have you Have you joined us again? Can you hear me, Richard?
Yes, I can, Paul. I'm here. Sorry, but I missed like the last 3 minutes, I guess.
That's okay. I was just asking whether you could share with us some thoughts on the transfer pricing consequences of business change.
Yes, for sure I can. In Germany, we have something that's called a transfer of functions. So there are some specific tax rules for tax authorities to tax such a transfer of functions. So in COVID-19 times, if you think about a multinational group that has, let's say, production entities, subsidiaries in Italy, Spain, and Germany that produce identical goods, and due to a sharp drop now in demand on the customer side, the production facilities in Germany, for example, are shut down. Then the question is that such a transfer of functions, and would that be taxable in Germany, a taxable event? Well, there is no definite answer. I think it depends on the circumstances. Also, I mean, we have to take into consideration, I think, how long this COVID situation is going to last. I mean, in Germany, at least, the first lockdown was, I think, in late March, early April, and then we went back, I think, after a month, and now we have a second lockdown light, as it is called. So, and also the leading virologists, at least, that that advised the government. So they said, well, this might well last, and I mean, not the lockdown, but at least the situation with the high infection rates might last until next year, June or sometime, or May, when they normally go down again, the virus diseases. But if this is just a temporary lockdown, that's the point I wanted to make. Probably this is not going to be a transfer of functions, but something to consider also because it's just temporarily. The question is then, is this a transfer of the use of function? And that's more to be the case, and then there wouldn't be a tax implication. I mean, one thing a taxpayer could consider is that this could also be seen as an opportunity, as there is, or if there is such a drop in demand, maybe this is a good time to transfer functions out of Germany, then, so to speak, to avoid taxation on a transfer of functions. Because I mean, you would look at the profit potential of the entity actually to determine the tax that becomes due in Germany. And of course, if the outlook now is grim or at least not very good, then maybe also the value then that needs to be attributed to the function. This is also lower than it had been before, and maybe that will be again in the future. So maybe this is an opportunity for some planning. Also, there is in the German law a price adjustment clause that is inherent. So even if there is no such clause in the actual agreements made, for example, in case of a steep decrease after transfer of function has taken place, maybe this is an opportunity to actually lower the value that had been attributed to such a transfer of function. So maybe this is something to lower taxes. Adversely, I mean, if you think about a steep ex post increase in value of a transfer package, for example, if we are talking about a drug that had been, or development capacities also of a drug that can be used to treat COVID-19 symptoms, for example, and that had been sold. And now, due to natural disaster, the COVID-19, the price increases quite a lot of that. I think there's some guidance in the OECD transfer pricing guidelines, actually, that could be used to argue that tax authorities would not be allowed in Germany to ex post then increase the value of this transfer package and actually increase the tax burden on that. So, so much my ideas on this topic. And I'll hand back to you, Paul.
Great, thank you very much. I'll turn next, I think, to Marcus. Marcus, have you got any views that you could share with us? Okay, it looks like we have lost Marcus. Marcus, are you back with us?
Yes, thank you, Paul. So let me.
Okay, I think we are struggling with Marcus's connection.
Okay.
Marcus, I'm sorry, we lost you after the first word there, so perhaps you could
That's okay.
start over.
Okay. I was just saying that there's different types of restructuring. So firstly, one can look at an organizational restructure, which really means changing your people. And by that, sadly, in the COVID time, we probably mean to get rid of some of the people. What can get interesting here is if you, for example, a service provider and you're still providing a similar service, but you're doing it with less people, what does that do to your service fee? And especially, what would a tax authority think about that service fee for previous years? So should that service fee and the benefit thereof still be the same, or should that maybe change? Also, from I guess, restructure perspective, you then get the supply chain restructure, which we've discussed a lot now already. And there we've seen prices that was now, and the COVID area is more of a resilience kind of effort. And what that means is it seems to, even though it's a restructure, what seems to be in getting the products out rather than trying to save on certain products. So interestingly here, that will have some transfer pricing elements that need to be considered. And then other restructurings can include things like your value chain. So when you look into your supply chain, that is more how to get product from A to B, whereas your value chain, that really have explored new markets currently and maybe have made promises. So again, there could also be certain changes that need to be considered. And then lastly, your product changes. So talking closely to the supply chain, what might have happened is that you stop producing a product altogether. Again, Richard spoke about that. African perspective, and specifically South Africa, what's very interesting in the restructuring world is that what we see a lot, the European headquartered companies that have a
Marcus, I'm very sorry, but the stream is breaking up. I think we lost some of the detail right at the end there. So perhaps if you could just wrap up on that point, and then we will move on.
Thanks, Paul. So my last point was just trying to say that even though South Africa might be seen to be similar to other European countries, when you look at your subsidiaries, what we notice a lot is that functionally speaking, South Africa is doing a bit more, and that is because it's further removed than other European countries, and it has different markets and cultures and so forth that you need to consider. So restructure doesn't always look the same. So you
Okay. All right. Thank you very much for that, Marcus. I'll perhaps just finish with a UK perspective and some of the things that I've been seeing with my clients, and I focus on the technology sector, amongst other things. And one thing that I have seen is really some of the change in how it is that organisations base themselves in a particular place, or now perhaps more accurately in places. We're all getting more used to virtual working. We're having this virtual event, which probably feels quite normal for many of us now. We're also seeing teams starting to work very well on a virtual basis, and businesses are looking at that and saying, well, actually, is our traditional model of everyone in the same place at the same time, does that still need to happen, or can we distribute out our teams and our functions? And of course, that does create some very interesting questions for transfer pricing when you start to have teams distributed across a number of territories. And I think that way of working will continue for some time yet. So I think we've all got some interesting challenges to work out who's doing exactly what where across distributed teams. So I'm going to turn again to the audience, and if we could bring our next polling question up, please. can't see that on my screen. Oh, sorry, here it is. So the question is, which of these, sorry, I think that's the third question. We're looking for polling question 2, please. So are you thinking of changes to your current business model as a result of COVID-19, e.g. supply chain, employee mobility, changes related to digitalization? So we'll give everyone a few moments to respond to these. Okay, I can see the answers coming in. Great. So if we could move us on perhaps to the results. So again, a very clear majority of people thinking through whether changes are required, but also clear that a significant minority are making changes or expecting to implement changes. And again, perhaps no great surprise there. We're living in a time of what feels like unprecedented change, so inevitably there will need to be change in response to that. And there are usually and often significant transfer pricing and tax issues to consider as part of that. So that's something very much to keep in mind as the business changes. So on the topic of change, and that has been a common theme throughout this, I'm going to move us on to our last topic of discussion, which is a change in the international tax framework. So Pillar 1 and 2 of the OECD unified approach to the tax challenges of digitalization are now with us in blueprint form. There's a lot of detail there. There's been an awful lot of thinking and work gone into that. And the OECD have a very difficult job to do. They need to forge political consensus within some strongly diverging views. And the consequence of not forging that consensus is a potential proliferation of unilateral digital services taxes, the potential for trade friction and tit-for-tat measures, which collectively would amount to a very real hit to global GDP. So the stakes are high. Many of you will be familiar with the concept, but as a very quick recap on Pillar 1, we have within Pillar 1 two amounts, Amount A and Amount B. And the intention for Amount A is to create a new taxing right, which would be in the jurisdiction where the revenue is sourced, and that taxing right would serve to share out a portion of residual profit with some definition that is different from the usual transfer pricing view of that, and that be allocated out to the markets where there has been an indication of nexus, and that is not the traditional tax nexus that we are used to. So we can talk more about Amount A, and in particular Amount B, which is a concept that is different from Amount A. Amount B is not a new taxing right. Rather, it is an attempt to standardize and streamline the application of the arm's length principle to create an expectation of a fixed return for certain baseline marketing and distribution activities. And whilst that's not been grabbing the headlines as Amount A has, it does potentially have very significant consequences for us here in transfer pricing. So I'm going to ask the panel for some views on both Amount A and Amount B. And it's a huge topic and very complex. So we'll come at this from an impact on a transfer pricing perspective. And I will perhaps start with Warren, if you could just give us some views on this.
Hi, Paul. Just to summarize something before I get into an observation. So what's generally happening through this Pillar 1 concept is that, as Paul said, there's going to be a recommendation of this amount B, which is supposed to be a fixed routine remuneration of profit to the entity in a jurisdiction that markets and offers the products or services and faces the users. And the amount A goes as an additional potential allocation of profit on top of amount B. And in total, the amount A allocation and the amount B is what is taxable profit in a market country. Now, the question that's coming up now is if amount A is only applicable to be allocated for businesses that have high levels of global profitability. And we haven't seen exactly what that number is going to be just yet, but it's expected to be above 10% profit relative to revenue. And the question mark that's coming up as interaction between this and pure transfer pricing principles is if amount A is in theory negative or below the threshold, does that eat into the amount B allocation? So if effectively a market jurisdiction should be getting amount A plus amount B, if amount A is negative, does the actual ultimate profit allocation go? Is it even below B, or is B the political question is B going to be the minimum expectation of market jurisdictions with no ability to go below B? And that's some of the details that we're waiting to hear as we go through the consultation process with the OECD. I think some of the general mechanics of the amount A allocation and the amount B determination are in the framework, but a lot of the sensitive discussion points have yet to be decided.
Great, thanks, Warren. And maybe let's focus on amount B at this point, because of the two amounts, it is the one that perhaps gets the lesser amount of attention. So, Frederick, perhaps I could ask you for some of your thoughts on amount B. Will it be helpful?
Yeah, I think about having amount B would very much be helpful. It would, at least for the cases in which it is applicable, prevent us from having discussions with the tax authorities about the percentage to be earned by distributing companies. And we have those quite a lot with the Dutch authorities, at least, especially when there are distributors outside of Europe. Within Europe, they're pretty much okay, and they know what to expect. But outside of Europe, they're really, really critical on the margins that are earned by distributors. On the other hand, when you look at the qualifications or on the list of indicators that you need to meet to qualify for this amount B, I do expect more scrutiny on that from the tax authorities. We still have to delineate appropriately what the intercompany transaction is. We still have to do a thorough functional analysis to make sure that we are applying the amount B to the correct type of functionality, to the correct type of distributor, not to a distributor that has less or a distributor that has much more functions than required for application of this amount. So in short, I think it helps, but it will probably put focus of the discussion with the authorities more on the functionality than on the outcome of the benchmark, obviously.
Indeed. Well, thank you, Frederick. Yes, and a very interesting question. Will it just move the focus of the debate and the potential for disputes to the character of the activity rather than the return that attaches to it via the benchmarking? So, Sabine, do you have any thoughts on what that might mean for how tax authorities approach this question?
So first, we are talking about topics which have been very, very, very recently discussed, because the outcome is a few weeks from now. So as a first comment, I would say that nothing has been, written, issued by French government or by advisors about this specific topic. So very difficult to give some useful comment on that, except of course, I mean, I fully agree with Frédéric. I think that we have to get back to the basics. We have to go back to the functional profile, and probably all these topics will open the door to discussion with tax authorities, and then based on a case by case basis. Again, I'm sorry, I repeat what I said a few minutes ago. I think that the new world opened by all what's happening now is that probably we'll have to keep our mind very open to discussion and to amendment with the figures, with the functional profile. So, and we will have to be stuck with always to go back to the basics, to the functional profile. So sorry not to be more specific, but it's so recent to give more background about that.
Yeah, and you're absolutely right, and it's clear that the blueprints are still works in progress. There's enormous amounts of political decision making that will need to be resolved. The state of the blueprints themselves are that they are documents to invite comments from interested participants in commentary, and that's open until December, and then expected that there will be a virtual consultation in January. So it's things are still moving around. There's still chance, I think, for people to contribute views on that. So if I perhaps could ask Marcus just for any last thoughts on amount B, and then we'll move into a polling question to finish up this section and wrap up, as we are almost at the hour. So Marcus, any concluding thoughts on amount B?
Thanks, Paul. So I've prepared this 5-pager that I would love to talk through, considering how long amount B is in the Pillar 1 discussion paper. But I think the one thing I want to bring out there, what's very interesting to see, is that someone actually took the time to put what is a limited risk distributor onto paper, and it's something we can actually now reference to. That is very interesting in my mind. However, as always being difficult from a transfer pricing perspective, what this also means is that it's very easy to get out of being an LRD, because now all you have to do is look at the negative list and implement one thing, and boom, you're out of it as a taxpayer. So this is something to keep in mind. The other thing I just wanted to mention quickly, in Africa, foreign exchange risk is a huge thing. We're talking changes in valuation of currency of over 10% on a monthly basis.
Okay, and I'm afraid, Marcus, we've lost you there. We heard though 2 very good points to think about, the character and then the FX risk being key. So if I could then move us to the concluding polling question, please. So polling question 3. So which of these is expected to have the most significant impact on your company? Pillar 1 amount A, amount B, Pillar 2, or digital services taxes? Okay, so let's see the results there, please. And DSTs, digital services taxes, are the winner, and those are the very real alternative on, I think, a much wider scale if the OECD are not able to get to an agreed place on Pillar 1. So thank you very much, everyone, for your contributions today. I'd like to say thank you to the panel, and I'd like to say thank you to everyone for your inputs on the polling questions. And we have had some questions come through, but I'm afraid we are out of time to be able to answer them on the session. So I think all that is left for me to do is to say thank you all very much. I hope you found this an informative session. We do have other webinars in this series which are focused on APAC and the Americas, so please do listen to those as well to get those particular regional perspectives, and also to direct you to our global transfer pricing website as well, where you'll see, amongst other things, a series with commentary and insight on these and other issues, and we hope that you find those informative also. Okay, well, thank you all. We will close the session here and appreciate everyone's attendance and input. Thank you all and have a good afternoon.
Thank you, Paul. And thank you everyone for attending today's webinar. CPE will be issued within 48 hours of this presentation via email. At that time, it will also be available under your profile on BDO.com. Click on the handouts icon on your screen for more information. You can leave the course at any time. Thank you and have a nice day.